3 buildings. That's all it takes. A few city blocks in Washington, a glass tower in Basel, a skyline of banks in New York. Inside those rooms, decisions are made in hours that shape the lives of billions for decades. You vote, you work, you save. But the architecture of the global economy, that was designed somewhere else. And most of us have never seen the blueprint. Tonight, we're going to look at it. Right now, the world feels unstable. Inflation flares up. Markets swing wildly. Governments drown in debt. Currencies rise and fall like empires. News headlines blame politicians. We're billionaires. We're the market. But beneath the noise, there is a structure, a quiet framework, a set of rules about who gets money first, who gets it last, and who decides how much exists in the first place. It's engineered, and once you see it, you can't unsee it. Let's start with something simple: money. Most people imagine money as something the government prints, hands out, and taxes back. That's not how it works. In modern economies, the vast majority of money isn't printed. It's created digitally, and it's created by private banks. Here's the mechanism. When you deposit $1,000 in a bank, the bank doesn't lock it in a vault. It lends most of it out. That loan becomes a new deposit in someone else's account, which can be lent again and again. Through this process, the banking system multiplies money. Not counterfeit, not illegal, designed that way. This is called credit creation, and it's the foundation of modern capitalism. Banks don't just move money, they manufacture it. Now ask yourself, who benefits from being closest to the machine that creates money? The answer begins at the top of the pyramid: central banks. In the United States, it's the Federal Reserve. In Europe, the European Central Bank. In Japan, the Bank of Japan. They don't compete for customers. They don't advertise. They don't run political campaigns. But they control the cost of money. Interest rates. Raise rates, and borrowing slows. Lower rates, and borrowing explodes. That single lever influences mortgages, corporate loans, government debt, stock prices, and even unemployment. One committee vote can ripple through every household on Earth. During crises, central banks do something even more dramatic. They create money at scale. In 2008, after the financial system nearly collapsed, trillions were injected into banks. In 2020, during the pandemic, trillions more. The money didn't fall from helicopters into ordinary bank accounts. It flowed first into financial institutions, into bond markets, into asset purchases, and asset prices surged. Stocks, real estate, private equity. If you owned assets, you got richer. If you relied only on wages, you watched prices rise. That wasn't a conspiracy. It was an incentive structure. Money enters the system somewhere, and whoever stands closest to the entry point gains the most. Now zoom out. Governments run deficits. They spend more than they collect in taxes. To cover the gap, they issue bonds. Investors buy those bonds, often with money that was created by banks or indirectly supported by central banks. Governments depend on markets to finance themselves. Markets depend on central banks for liquidity. Central banks depend on credibility and stability. It's a circular architecture. Each pillar supports the other, and all of it rests on confidence. Not gold, not physical reserves, confidence. Here's where it gets uncomfortable. Global power doesn't just come from military strength or natural resources. It comes from controlling the currency everyone else uses. The US dollar dominates global trade. Oil is priced in it. Debt is issued in it. Reserves are held in it. This gives the United States an extraordinary advantage. It can borrow in its own currency. It can run persistent deficits. It can export inflation. When other countries need dollars to pay debts, they must earn them through trade or borrow them through global markets. That creates dependency, a hierarchy of currencies, a hierarchy of nations. At the center sits the issuer of the world's reserve currency. Not because of a secret treaty, but because of history, trust, and financial depth. Power doesn't always shout. Sometimes it settles quietly into infrastructure. Now let's talk about markets. We're told markets are free, neutral, merit-based. In reality, markets are shaped by rules, regulations, capital requirements, access to liquidity, bailout expectations. In 2008, major financial institutions were rescued because they were too big to fail. It's architecture. Now consider the math. Global debt today exceeds global GDP. Public and private debt combined sit at levels unimaginable 50 years ago. Why? Because growth itself is built on credit. To expand production, businesses borrow. To fund programs, governments borrow. To buy homes, families borrow. Debt pulls demand from the future into the present. As long as the economy grows faster than the interest on that debt, the system holds. If growth slows while interest rises, strain appears, and central banks face a dilemma. Raise rates to fight inflation, and debt burdens intensify. Lower rates to ease debt, and inflation may surge. There is no painless setting, only trade-offs. Publicly, we hear narratives about capitalism versus socialism, free markets versus state control. But the reality is hybrid. Private banks create money, central banks backstop them. Markets price risk, and ordinary people supply labor and taxes to stabilize the base. It's not a free-for-all, and it's not total control. It's managed capitalism, a choreography between institutions that most citizens never voted for directly, yet depend on daily. Here's the irony. The system works remarkably well, until it doesn't. It has lifted billions out of poverty, enabled global trade, funded innovation, built infrastructure. At the same time, it amplifies inequality, rewards asset ownership over wages, concentrates influence in financial hubs. The architecture produces growth, but it also determines distribution, and distribution shapes politics. Long-term, pressures are building. Aging populations, rising geopolitical tensions, climate costs, technological disruption, each adds fiscal strain. Each demands investment, more monetary intervention. Meanwhile, alternative systems emerge. Digital currencies, regional trade blocs, efforts to reduce reliance on dominant reserve currencies. None have replaced the current order, yet. But architecture evolves when stress accumulates. History shows this. The gold standard ended. Bretton Woods collapsed. Floating exchange rates took over. Each shift rebalanced power. Quietly, then suddenly. So who really controls money and power? Not one person, not one institution. Control is layered. Central banks control liquidity. Commercial banks control credit creation. Governments control taxation and regulation. Markets control pricing and discipline. And reserve currency issuers control global leverage. But not evenly. The closer you are to the creation and allocation of capital, the more influence you hold. Everyone else operates within the boundaries those flows create. The hidden architecture isn't hidden because it's secret. It's hidden because it's complex, because it's gradual, because it feels technical, but it shapes housing prices, job markets, retirement savings, national stability. It determines who absorbs shocks and who is shielded from them. The real question isn't whether the system is good or bad. It's whether its incentives align with long-term stability. Can an economy built on expanding credit grow forever? Can reserve currency dominance last indefinitely? Can inequality widen without political consequences? Architectures don't collapse overnight. They strain, they adapt, they reform, or they fracture. And when they fracture, the blueprint gets rewritten, usually by those already inside the building. So the next time you hear about an interest rate decision, or a bond market panic, or a new trillion-dollar spending bill, remember, somewhere, in a quiet room, a lever is being pulled, and the structure shifts. The question is not whether there is an architecture, the question is this. When the next redesign comes, who will be holding the pencil?